So it's everybody's favorite time of the year again, tax time. So we're getting all our forms in the mail. We're starting to get ready to file our taxes. And, typically this is going to be a little bit of an easier tax season. At least, we prepare taxes and you don't have stimulus payments. You don't have advanced child tax credit payments. So it should be a little bit more normal, sort of pre-COVID normal. But the problem is a lot of the things that they did for the past couple of years due to COVID are now going away. So it's going to have an impact on a lot of people. And in particular, if you have children, you are going to be impacted by what the tax law is for 2022. And it's not going to be pretty. There are a lot of things that were provided for taxpayers with children, for daycare, that have gone away. So if you have kids, if you utilize daycare, you probably need to expect a little bit of a lower refund this year, or if you typically owe, you're going to owe quite a bit more. And we'll get into that. So we'll just start off with, just looking at the tax rates. So one of the nice things is they make adjustments to tax rates and quite a few different deductions due to inflation. So the tax rates have gone up a bit here. So the first column you'll see that's for single taxpayers. You can kind of look at the 10, 12, 22% bracket. They've all bumped up. The second column is for folks who are married filing jointly, or a qualifying widower or qualifying widow, which they have now changed to qualifying spouse. So in today's world, they've got to do all that stuff now. They can't call you a widow or widower because I don't know. So it's just qualifying spouse. So that's what you're looking at as far as tax brackets. So a little bit more relief there. So you can make a little bit more money and not pay higher taxes. That's a good thing, right? And it's all based on the inflation adjustments, since inflation was so bad last year. That's why we're seeing this. Okay, so let's jump into the first thing that I was talking about as far as bad news, and that's the child tax credit. So this chart shows you the difference between 2021 and 2022. Now, during COVID, Congress and the president authorized a much higher amount for the child tax credit. So any child under the age of 6, you qualified for a $3,600 tax credit. Even from age 6 to 17, you still got a $3,000 tax credit. And the beautiful thing was, it was totally refundable. And what does refundable mean? Well, refundable means, let's say you've got one child and you do your taxes and your tax liability. So after you factor in your adjustments, you take your standard deduction, all that stuff. Let's say your tax liability is $2,800. So the $3,600, normally if it's a non-refundable tax credit, you would get $2,800 of the child tax credit, and that's it. You would zero out what you owe the government. That's as far as you could go. Refundable means that even if you zero out your tax liability and you still have some credit left, the government will give you that money. So you can actually make money. So it's totally refundable. Great thing. The other big thing to notice here is for the $3,000, it went through age 17. Now, as a tax preparer, I always had people very upset because the child tax credit before COVID went up to age 17. So basically 16 or younger. And a lot of times people get upset because their child is still in the house. Maybe the child's a senior in high school. So you think they're still a child in your eyes. They're not even off to college yet. but yet you lose that child tax credit. So now let's look at the column just across that for 2022. We're back to the old rules. So we're back to that age 16. So 16 or under, you get the child tax credit. So if you have a child who is now 17, even for one day of the year on 12/31 of 2022, if they became 17, you're out of luck. That's a big change. Also, look at the amounts. So we're dropping from potentially $3,600 if they're under 6, or even $3,000 up to age 17. We're back down to $2,000 for the credit. So if you have 2 kids in the house, and let's say they're both under 6. So, hey, if you've got 2 kids under 6, you earn some extra cash in my mind. I remember those days. That's a lot of work. So last year in 2021 taxes, you would have gotten $7,200 for a tax credit. This year, $4,000. So you could do your taxes this year and find out you're getting $3,200 less than you did the year before. That's going to be painful. Not only that, but only $1,500 of the tax credit now is refundable. So here again, remember, if you zero out your tax liability, the most that they will do here is $1,500 of a refund, whereas before it was totally refundable. Okay, so that's the first part. But the second part that's really, really painful is the phase outs. Okay, so it was kind of a clunky rule before, like you got the 3,600 or 3,000 unless your income hit 150,000 for married filing joint, 112.5 for head of household, or 75,000 for all other filing statuses, married filing separate or single. So essentially what it did then is if you got above those income levels, they capped it to 2,000. So remember, 2,000 was the figure before COVID hit. So what they said is, okay, well, if you make, roughly, let's say under 150, just to keep it simple, if you made under 150, we would give you the 3,600 or 3,000. If you made more than that, we're going to use the old child tax credit rules and cap you at 2,000. And then they also had a second phase out for the $2,000, but it was $400,000 for married filing joint and $200,000 for all other filing statuses. So if you made under 400 or 200, then you got the 2,000. If you made more than that, you started to phase out of that 5% for each 1,000 of income beyond the phase outs. So it was kind of convoluted, but now you can look and see the phase outs are now just 400 and 200. But of course, 2,000 is the maximum. So that's kind of stayed the same for that 2,000 phase out. They've just pulled out the $3,600 and $3,000 option. And then the other big thing, though, I've got a little arrow there talking about the refundable part. So we talk now for 2022 and thereafter, $1,500 is refundable, but you have to have earned income in excess of $2,500. So you can't just be kind of sitting at home, collecting, welfare. The other thing is you only get 15% refunded above earning $2,500. So it's much tougher to get that refundable tax credit now. Whereas before in 2021, it was quite easy to get it. So bottom line, if you have kids and you're used to getting these tax credits, expect to see that go away. Okay, you're going to lose a lot of credits on this. Don't blame, as a tax preparer, don't blame your tax preparer for this. I've already, my first return we did, I've already had somebody who had a child and she complained about her refund being less than last year. And I showed her this. I said, well, you're looking at $1,600 less than what you got last year, right off there. So it was literally that $1,600 was almost the exact amount that she got more in 2021 as opposed to this year. So I know it's going to happen. Don't blame your tax preparer. Be ready for this. If that's not bad enough, even worse is the change in the child and dependent care credit. This one really dropped. Now, the government really, I think they went a little overboard in 2020 and 2021, providing that for parents. But this is going to be a drastic change. We're going back to the pre-COVID levels. So let's look at it. In 2021, you could deduct, the factor you would look at for the credit is $8,000 for one child, or $16,000 if you had more than one. So if you had 2, 3, 4, 5 in daycare, if you have 5 in daycare, whew, I feel for you. But anyway, so it was $8,000 and $16,000. We could take those expenses and use that to determine your credit. Now we're back to $3,000 for one child and $6,000 for more than one child. That's a huge drop. I mean, that's enormous. That's a big time drop. So you're going to have less of your expenses that you're going to be able to calculate your new credit. The other thing is, for the COVID rules, you could deduct 50% of those expenses. So of the $8,000 and $16,000, you could deduct 50% of that. So $4,000 for one dependent. And then if you had more than one, it was $8,000. That's a pretty big credit. Okay, that's a huge credit. $4,000 you're getting back if you were paying $8,000, and you were getting $8,000 back if you're paying $16,000 or more for more than one child. That's pretty huge. Now we're back to 35% of the allowable expenses. So 35% of $3,000 or 35% of $6,000. So now the maximum credits you're looking at here is $1,050 for one child and $2,100 if you have more than one child. That's a big drop. I mean, you're looking at $3,000 for just one child. Well, close to $3,000. But you're looking at almost $6,000 drop if you have more than one child. So if you had 2 children in daycare or dependent care last year, you might have had an $8,000 tax credit. And remember, a credit is better than a deduction. A credit is a dollar for dollar credit or refund of your tax dollars, whereas a deduction just reduces the amount of income that's taxable. So these credits are huge. It's a dollar for dollar back in your pocket. So you may have gone from $8,000, and this year, if those 2 children are still in daycare, you're only going to get $2,100. I mean, you're looking at $5,900 less of a refund this year as opposed to last year. That's going to be a shocker. The other big thing is the phase out limit. So they didn't start to phase you out with the 2021 rules until your adjusted gross income got above $125,000. So you could have a pretty substantial income and still get this full credit. Now, look at that on this chart, $15,000 of AGI you start to phase out. So by the time you get to $43,000, you're pretty much phased out of the child and dependent care. That's not a huge income there. I should say it's phased out of $43,000. Sorry, you're only going to get 80% of the child and dependent care once you hit $43,000. But that's a very low level. The phase out in 2021, you could go up to $400,000 before you're fully phased out. So the rules not only gave you more money last year, but you could have a much higher income and still get that credit. That's not the case anymore. The only good thing that they're doing, and they continued this, is if you have a deduction from your pay, a pre-tax deduction for dependent care, the government allowed you to roll the amount over from 2020 to 2021, and now they extended that to 2022. So if you didn't use all your dependent care expenses, you can get up to $5,000 can be withheld from your pay pre-tax in order to pay for dependent care. So you can still roll that over if you didn't use it all last year. That's, I guess, one good thing, considering they just ripped that credit to shreds. The other bad thing for people, lower income folks is the earned income tax credits had some changes. And not for the positive. Looking at a taxpayer with no qualifying child, you're going to see the maximum benefit drop by almost 2/3. It's going down to $560 for 2022 as opposed to $1,502 in 2021. Not only that, but then the income levels are also going down, not up, even with inflation, but they're going down. So now you're looking at $16,480 for somebody who's single, whereas in 2021 it was $21,430. And for 2022 for married filing joint, it's $22,610, whereas last year it was $27,380. So that's pretty painful. That's pretty painful if you're on earned income credit. So they hammer you, they punch you in the gut, and then they're going to give you a little pat on the back here. They are now allowing married filing separate to get earned income tax credit. Before, that was something they would not do. The government does not want you filing separate because they're trying to keep people from gaming the system. So they would take that away completely if you're married filing separate. So they're now allowing you to file married filing separate and get the earned income credit if you meet these qualifications. And that is basically, you don't have the same principal residence for the last 6 months of the year. So you cannot live together for the last 6 months of the year. And you had some sort of formal legal separation instrument that dictates why you're separated. So it couldn't just be like you kick the guy out of the house in the last 6 months and now you want the credit. It's got to be, there has to be some sort of separation agreement in place. Okay, so we mentioned inflation's affected taxes this year with the tax rates, but it's also going to help on business miles. So everybody knows it was painful to fill your gas tank with gas the past year. So the government has recognized that and they've increased the rates. You can see here for January 1 through June 30th, you're going to get 58.5 cents per mile. And then they made another adjustment so that July 1 through December 31st, you'll get 62.5 cents per mile. So you bumped up the business mile deduction, which is good. It should. I mean, gas went way up. But you are going to have to split this out based on January 1, June 30th, and then July 1 to December 31st. So again, the IRS, they require that you have a log of your miles during the year. So technically, it shouldn't be difficult to determine which miles were driven in the first part of the year, which miles were driven in the second part. This also applies to medical mileage. So as an itemized deduction, if you are deducting medical expenses, if you meet that criteria, which is expenses above 7.5% of your adjusted gross income, it's a difficult deduction to get, but if you have a major medical issue, you might get there. So anyway, they've also increased the medical miles there. First half of the year, you're going to get 18 cents per mile. Second half of the year, 22 cents per mile. Another thing that's really going to hit people, probably slug them right in the gut. In the previous couple of years, the government has extended the private mortgage insurance deduction. So if you have a mortgage and you're paying PMI, you were able to deduct that as an itemized deduction. That is no longer available as of this year. So in 2022, when you file your taxes, you can still deduct the mortgage interest, but you're not going to be able to deduct the PMI if you paid any. So that's going to hit a lot of folks. There's a lot of people out there who, maybe they're on FHA or VA mortgage and they have some sort of PMI and they've lost that deduction. Another little benefit, I guess, a good thing is they extended for at least 2022 that meals served in a restaurant or food delivery are deductible at 100% of the cost. Usually those are 50% deductible, but during COVID, in order to boost up the restaurant business, because it took such a hit when we shut down, they increased that to 100%, hoping that businesses will go out to eat more. So that was extended through 2022. You still have the 50% threshold for things like in-office coffee or snacks or stuff you just bring in the office. Those are only 50% deductible. You have to go to a restaurant or food delivery to get the 100%. As I said, this is only good through 2022. Once we get to next tax season for 2023, we're back to 50%. Another thing that is going to be another swift kick to the groin for most people. During COVID, they actually put something in place where if you were single, you could deduct $300 for charitable, even if you didn't itemize, and $600 for married filing joint. So somebody who was renting or didn't have enough in itemized deductions could still get credit for giving money to charities. And I think it goes back to after COVID hit, a lot of people weren't donating as much to charities, so they tried to ramp this up. I actually think this was a bad idea to get rid of this. I think it's fundamentally unfair that somebody who rents their place to live and gives to charity doesn't get a deduction, whereas somebody who owns a house and gives to charity has the potential to take that charitable deduction as an itemized deduction. I don't think that's fair. I think we should encourage all Americans to give to charity. So it's either you give to charity or you don't, and then you should get a deduction for it. So that, $300 for single, $600 for married filing joint, that's gone this year. It's not on 2022. So that could be another little tax bill you're going to have because you can't deduct those expenses. Okay, so those are the biggest things that have changed this year. And like I said, I think there's going to be a lot of people who are going to be awfully upset when they get their taxes done, especially if you have kids. If you have kids, it's going to be pretty brutal, and I'm not lying to you. You're going to lose some serious credits. And particularly if you were sort of a higher income family or person, and you were able to use those higher thresholds to get the child tax credit, then that's going to be gone. There's some positives that are happening. Things have been inflation adjusted. They extended a couple things, but for the most part, this is not going to be a good year for tax filers. It's going to be a good year for government revenues, but not for you. So I just wanted to get these things out here for everybody so you can know what's coming, so you can prepare yourself when your tax preparer gives you some bad news. But we're basically back to pre-COVID, and that's sort of what they've decided to do. You may agree or may not agree, but just be ready for it because there's nothing you can really do about it at this point.